two different sets of dynamics. So I think there is ultimately there's the markets priced in dollars and there's the markets priced in gold. And if you look at the markets priced in dollars, we're at all-time highs. If you look at the markets priced in gold, we're still down about 30% from the highs of late 21, and we're still down I want to say 30 or 40% from January of 2000 in the U.S. So using gold as a way of saying how much of it is currency debasement versus how much of it's real growth, real productivity. And so with that framework, I think on the equities priced in dollars, I think the shape of the chart is going to be roughly the same. It's going to look like the old Nike symbol on your shoes, right? Which is, I think, and the war may be the catalyst for it. China AI competitive gains may be the catalyst for it. Who knows what the catalyst will be for it. When your valuations are in la-la land, which equity valuations are in the U.S. and in a lot of places, the catalyst doesn't really matter. Nothing can go wrong. Nothing is allowed to go wrong. You're not allowed to have any issues, any questions with valuations that are this high on things like the Warren Buffett metric, equity market cap as a percent of GDP, et cetera. And so I think we're going to get, something is going to be a catalyst, and we're going to get sort of a Nike-shaped market where you get a slight drop down, and I don't know what slight is. Maybe it's 10, 15, maybe it's 20%. I doubt it, but could be. And that will cause treasury market disruption, dysfunction, and that will be the catalyst for more dollar liquidity. And that'll send us right back to the highs. And that's been kind of the playbook for the past 5, 6, 7 years. Now, in gold terms, I think if you have an issue, gold probably goes down a bit initially, and we've seen that. And so that I don't have as strong a conviction in that. We've already seen gold well off the highs. And so maybe gold goes down a little bit in that initial risk off in the dollar denominated equity markets. But then ultimately gold soars, and as the decline in equity markets necessitates, creates dysfunction in treasury markets again, and necessitates more dollar liquidity injected by either Fed or Treasury again. And gold goes back to new all-time highs. And so on a dollar base, I think you get sort of the Nike shape in equities. And then on a gold basis, I think you end up with the chart, more of what we've seen since 2022 and since, 2000 really, which is, on a gold basis, equities, that's where the correction in equities has been and where I think it will continue.
There's a pattern these observers keep flagging in recent downturns. Equities sell off hard enough to gum up the plumbing of the Treasury market, which then forces the Fed or Treasury's hand into pumping fresh dollar liquidity into the system. And markets snap back to fresh highs almost as fast as they fell. Some analysts have nicknamed the resulting chart shape a swoosh, a quick shallow dip, then a steep climb back up. What actually triggers each dip barely matters in their view, with valuations stretched as far as metrics like market cap to GDP suggest. Almost any shock could set it off. It's the recovery playbook that stays constant.
I think that's exactly what we've seen, which is there's been some reserve selling for energy, for liquidity. No question about that. There's been selling of, alongside treasury bonds as well, for reserve selling / liquidity. And I also agree with the point that if you get into a global, a real, not just because I don't think we're going to get a world war per se. It's possible, but I don't think that's what we're going to get. But if you just get what everyone's saying we're going to do, which is sort of an economic divorce between China and the U.S., then gold has to soar, because China's not going to use the yuan and run deficits in yuan, even if they could. But they're not going to. They have set up offshore yuan clearing banks in every major gold hub in the world. So London, Switzerland, Dubai, Singapore, Hong Kong, and of course Shanghai, where if you end up running surpluses against the Chinese or you have excess yuan by virtue of trade with the Chinese, you can recycle those yuan surpluses into gold at any of those places. And that's how China's going to internationalize the yuan. They've been very clear about this for 10 or 15 years, and the West just continues to generally ignore this because they don't want to hear it, because they don't have a trump card for it. So to the extent this war continues doing what it's doing, I think it is initially negative for gold, but I think gold will bottom, and I think it's a really important relationship to watch, right? Because exactly what you just said is what everybody's watching for, which is, okay, war on, gold down, war off, gold up. And I get that initially, but the longer it goes on, there is a day coming where we're going to say war on, gold up. And that's a really important day, because that will be the day where people go, okay, fine, this is going to last for a while. I need to do some of my business in yuan. I need to do some of my business in dollars. All the business I do in yuan, I'm going to be buying gold for, and shifting any surpluses in yuan that I earn into gold. And that will be a really big moment. And I think that is ultimately how this war ends up. It ends up backfiring on the U.S. in terms of if part of this was done to enforce dollar hegemony, all it's going to do in the long run is accelerate its end. I have a small position of silver. I bought probably $18, maybe, 8-10 years ago. I do think silver is wildly mispriced as an industrial metal today. And I also think it is an Achilles heel of sorts of the credit gold and credit silver system that does support the post-1971 dollar system. So it does have monetary elements. And when I mean credit gold, I mean the unallocated silver and gold derivatives that basically when demand kicks up for something, there's two ways you can address it. And in particular, when there's demand for gold and silver that picks up, there's two ways you can address it. You can allow the price to rise and physical to move, or you can allow unallocated derivatives to expand and address that supply and let price stay still. And generally speaking, over the last 50 years, the latter has been how increases in demand for gold and silver have been addressed. I think physical holders of silver will be rewarded over time, just because, again, when you look around at everything we're trying to do, we're trying to build redundancies to the industrial base that China has built around the world. Us, Japan, Korea. Maybe the Europeans will really finally get their act together in certain energy stuff too. Who knows? But the point is that all of that stuff can't get built with paper silver. It's got to get built. There's silver is just used in so many different places, especially as it relates to anything EV/electric, solar panels, etc. So I think physical holders of silver will be rewarded over time, but I don't know if over time is 2 months, 2 years, 2 decades. I would guess it's probably within 2 years, but I don't have a strong feeling on that.
China, meanwhile, has spent more than 10 years quietly building out an alternative payment network for its currency, setting up offshore yuan clearing banks in gold trading centers like London, Zurich, Dubai, Singapore, Hong Kong, and Shanghai. The idea? Any nation running a trade surplus with China and stacking up yuan balances can convert those straight into gold at one of these hubs, skipping the dollar entirely. Some strategists make the counterintuitive case that drawn-out geopolitical tension actually speeds this along. It dents gold prices short-term as capital flees to cash, but over time it persuades more trading partners that gold-backed yuan settlement is the safer long-term bet.
Gold has begun its return into the system as a neutral reserve asset. We're at least 12 years into that shift, at least. And you can see that. You look at global FX reserves, dollar reserves have not really moved in 12 years. Treasury bond reserves have been flat for 12 years, and gold reserves have risen meaningfully. So central banks have been growing holdings of gold and not growing holdings of treasuries, while treasury supplies have been growing exponentially for at least 12 years. So this is already 12 years underway. And I've been very clear that I think the post-1971 structure of the dollar system is ending, but the dollar's not ending, and I don't think it will in my lifetime, or really even my kids or grandkids, not that I even have grandkids' lifetimes. It's changing. It's changing to a neutral reserve asset, gold, that floats in all currencies. And Everybody wants this. The PBOC came out in 2009 and said we want to move to a non-credit-based, commodity-related, or currency issued not by any single country. It's gold. And then they started buying gold a few years later, much more aggressively. And you can see declassified documents from U.S. State Department that China's buying gold because they see it as a way to kill two birds with one stone and build their own resilience. The IMF came out in 2011, said we should think about moving away from dollar monopoly of oil and instead move it to something like an IMF SDR and price gold and oil in IMF SDRs, not dollars. Say think what you will of it. The Dominic Strauss-Kahn, who was in charge of the IMF when that was proposed, ran into a sex scandal and was removed from office 3 months later. Moving on, World Bank, former Treasury official Robert Zoellick, 2010. We need to move to a system where you have the goal, or excuse me, of euro, yuan, or euro, yen, pound, and dollar, and a yuan that starts to open up its capital account. And we should also use gold as a reference point for inflation expectations, growth, etc. And then most recently, and perhaps most importantly, because we are the incumbent in control of the past system, the U.S. has been talking about Hamiltonian economics. Besant gave a speech at the New York Economic Club 4 weeks ago. He, same day, posted a Wall Street Journal op-ed on the same topic, that Hamiltonian economics back Trump's economic statecraft. The Hamiltonian economics theme echoes what U.S. Trade Representative Jamieson Greer said in January at Davos, saying we're done with the old system. The United States is moving to a Hamiltonian economic system. Vance and Trump have alluded to it as well. And so the key here is that you can't do a Hamiltonian economic system with the post-1971 structure of the dollar. You just can't, full stop. Because Hamiltonian economics is we're going to put up tariffs, and we are going to implement industrial policy. And when you do those things, you don't emit the dollars needed for the system to run. So the world goes to gold. So to me, what Besant said, 4 weeks ago, everyone on Wall Street virtually is like, Besant is the adult in the room, et cetera, et cetera, et cetera. Besant's telling you the gold's coming back in the system. That's what he's telling us. When he says Hamiltonian economics are backing our Trump's economic statecraft, that's what's happening here. So now, what does that imply? That implies much higher gold prices. That implies a much lower trade value of the dollar against the creditor currencies like the yuan, the yen, to a lesser extent the euro. And that would be a system that would lead to perhaps the greatest economic boom worldwide since the end of World War.
Reserve data backs up a slow-moving shift that's already been happening for years. The People's Bank of China hinted as far back as 2009 that it wanted to move away from a credit-based reserve system. Meanwhile, dollar and treasury holdings across global central banks have basically flatlined for over a decade, even as gold reserves keep climbing. Various officials have floated adjacent ideas over time, too. The IMF has discussed tying commodities or SDRs to gold, and the World Bank has commented on referencing gold within a multi-currency framework. More recently, U.S. Treasury officials have talked about a Hamiltonian economic approach built on tariffs and industrial policy, something some analysts say just doesn't square with the dollar issuance demands of the monetary system that's been in place since 1971. The implication, in their reading, gold's role in reserves keeps expanding no matter who's actually driving the shift.
It does feel that way at times. And I think it's part of the long cycle, right? Everybody wants to talk about the fourth turning, and we're heading into a fourth turning. And then, sort of part and parcel to fourth turnings is faith in institutions, collapses. And what people tend to leave out is, why does faith in institutions collapse as well? Because you get stuff like this. And I agree with you. It's both sides of the aisle. And it's been frustrating as an American to watch. Now, I would say it's encouraging. The U.S. has been designed to survive being run. through periods like this. And I'm hoping that will continue to be the case. But I think part of it, is a recognition by elites of this sort of, get yours while you can mentality that has really been enforced by events of the past 30 years, and in particular, let's call it 25 years. Iraq War II, the GFC bailouts, and then COVID, where a lot of people made a lot of money on shady, if not illegal, actions, and there were no repercussions. And so if you can get rich and there's no repercussions, guess what you're going to get? You're going to get a lot more illegal actions, and that's what we've seen. So I think it's, what did Charlie Munger always say? You show me an incentive, I'll show you the outcome. If you get a bunch of, a small number of people getting rich on illegal actions and no repercussions, then you're going to get more people doing more illegal stuff and shady actions, and they're going to push it as far as they can go until... look, I think ultimately, I don't know if you get full-on revolution or total collapse. That's not where I think it'll go. I think we're getting the warning signs of our system as it's been designed to function, right? When you get a Mamdani, a professed socialist, borderline Marxist, in charge of the center of capitalism in New York City, that's a warning. When you get Charlie Kirks of the world getting shot, that's a warning. Charlie Kirk was just having a conversation. When you get, the Brian Thompsons of the world, the former head of United Healthcare, president of United Healthcare, gets assassinated on the streets of Manhattan. These are warning signals. And when you read about these periods in time, somebody who studied this a lot is Peter Turchin, and he said there's two things to watch for. It's wealth inequality and elite overproduction is what he calls it. When you've got more elites than you know what to do with, and then when you have wealth inequality then you get these really extreme tail outcomes in terms of political outcomes. And what I'll say about all this sort of corruption and shadiness and some of it outright illegality is this is where we're heading. And and what Turchin says is it's the United States, as he measures it, is at the highest levels of the combination of wealth inequality and elite overproduction that we have seen as a country since the late 1850s. And of course, from 1861 through 65, the United States fought the Civil War. And it's fascinating because I'm reading a book now by Eric Larson, a new book of his called, Something Demons. Unleashing the Demons or something like that, about sort of the 3 or 4 or 6 month run up to the Civil War getting kicked off in Charleston Bay. There's a lot of stuff that's rhyming. So, look, I hope we can avoid that kind of an outcome, but history would tell you, and